This is your Lead Left podcast for the week of June 5th. I'm Randy Schwimmer. Welcome back. We concluded our current private debt world tour with stops last week in Geneva and Zurich. As was the case with our previous visits in various overseas capitals, investors shared similar concerns about the world of volatile liquid markets and the relative stability and value in private markets. The Swiss economy, while losing steam since early 2022, remains in positive territory. Contrast its 0.6% first quarter GDP with neighboring Germany that's in a technical recession after two consecutive down quarters. This may be accounted for by different sector strengths. Swiss industries such as financial services, biotech, and specialty manufacturing compare favorably from a cyclical perspective to Germany's automobiles and chemicals. Add to that the weight of higher German energy costs from its shedding dependence on Russian natural gas. Our friends in Geneva and Zurich were a mix of family offices, wealth managers, and institutional investors. These firms shared a sophisticated approach to alternatives. Real estate, as one example, has been well supported for decades as a successful diversifier from the traditional 60-40 model. A similar appreciation involved private equity. Here, questions revolve around the relative value of private equity returns compared to private debt. Will the significantly higher all-in yields and corresponding financial burden on borrowers accruing now to direct lending hurt sponsor returns as they raise new funds? Our Arcmont and Nuveen colleagues also shared views on European debt markets, which are less developed than the U.S. The nuances of each country's legal jurisdictions make it difficult to have a truly pan-European credit platform. That also creates an opening for those lenders with scale and relationships to take market share. Investors inquired about the outlook for quality deal flow in the current high-rate environment. While activity for the first half of the year has been muted compared with the second half of 2022, bankers are seeing a rush of books for properties being positioned for sale. Finally, we highlighted how experienced managers build portfolios to weather recessions. How do we deal with problem situations? Will the current crop of loans produce higher or lower defaults and recoveries? How do private debt valuations compare to public ones? While the uncertainty of growth, inflation, and rates hovers over asset managers regardless of region, those conditions position private debt as an increasingly essential asset in any diversified portfolio. Reporting from the Little Switzerland office at the Lead Left, I'm Randy Schwimmer, wishing you and your families a safe and healthy week.